Hi, my name is Jason Tank from Traverse City, Michigan. I've got one kind of quick question that I'm sure you can answer relatively quickly if you're not interested. I know that Walter Scott's on the board of directors, and he's also on the board of directors of a company called Level 3 Communications that is in an industry that's, well, there's been a lot of change happening, and stock prices have been plummeting. I wonder if you've probably spoken to him at great length about the economics of that business. And have you ever expressed any interest in that business, especially at the prices today? That's the first question. The second question is, if you look at Berkshire Hathaway as a portfolio of, you've got wholly owned subsidiaries as operating businesses, marketable securities, common stocks, and bonds. If you strip out, and if my premise is wrong, just please tell me. If you strip out the leverage effect of the cost of the float being nearly zero or negative throughout the years, if you look at the portfolio minus that leverage piece, how fast do you think your book value would have grown over the last 30 plus years? Are we talking about 5 or 6% due to just the leverage piece on the insurance float?
I don't think it would run as much as 5 or 6 percentage points, but the float has been very useful to us. And actually, I've never made the calculation, so you could well be correct that if it was 5 or 6 points, that would be a quarter of our book value gain over the years being attributable to insurance float. And I think that's probably maybe on the high side, but and you can't make it. We don't look at insurance float 100% the same as we would look at equity, but we've looked at it a good bit. Is largely tantamount to equity because we've had so much equity we could afford to do it that way. So you'll have to make that calculation yourself. We think insurance float has been a huge asset to Berkshire. We think it'll continue to be a huge asset, and we look for every way possible to increase the amount of low-cost float. On a small scale, we added U.S. liability last year, an excess surplus lines carrier based in Philadelphia. And so far, that's working out extremely well. I've got a terrific guy running it. And, in a small way, we add float there. I just looked at the first quarter on it, and we had a significant underwriting profit, and we had float added. And, that's the best of all worlds. So we'll keep working on it. And it will add. It's a big asset that Berkshire has that a great many companies, virtually no other company has it to the degree that we have, that also invests in other businesses and uses it as a source of money to invest in other businesses. Question about level 3, I obviously can't answer. I can tell you that you have two enormously smart and high-grade guys in Walter Scott and Jim Crow in that business, but it's not a business I know a lot about, and if I did, I wouldn't talk about it. Charlie?
I cannot talk just as well as you can.
Not always. Okay, section 4.
John Gollop from Kansas City. I have a follow-up question to your comments about how financial statements can be distorted by making over-optimistic assumptions about returns for the pension portfolio. If you believe accounting statements, as published in annual reports, returns on equity for U.S. businesses are amazingly high, higher than in Europe, higher than they've been historically, higher than Japan. Are these highs, do you think, completely attributable to accounting shenanigans, or are there any fundamental reasons in addition that might make returns in the U.S. higher than in Europe or higher than they've been historically?
Well, I would say that they certainly, to the extent that American returns have been higher than those around the world, at least in developed countries, I would say that they are not solely due at all to accounting shenanigans. I think that the absence of honest accounting for option costs has been a factor, but American business has done very well, excluding any accounting activities that Charlie and I might differ with. I'm no expert on exactly what returns have been around the world in developed countries, but my impression definitely is that American business is well above average for the developed world in terms of profitability. And I don't have the answers as to why that's occurred. I think that American business and I think the whole American system has reflected more of a meritocracy than exists in many countries, and I think that a meritocracy works best. I think that mobility between classes, which is the flip side of a meritocracy, does tend to get the Jack Welches into positions of where they run a General Electric or an Andy Grove or an Intel or go up with Sam Walton at Walmart. I think if you'd taken those same individuals and dropped them down in most countries, they would have done very well, but I don't think they would have done quite as well as here. And I think that what they have done well has spilled over in a big way to benefit the American economy. So I would not lay it all on the accounting shenanigans. And the pension fund accounting, that applies very heavily at some companies. And of course, most newer companies don't have pensions. Companies that have started in the last 20 or 30 years are much more inclined to have various kinds of profit sharing or 401ks. The older industries that took on pensions, spurred to a great degree, I think, by World War II, when you got excess profits taxes that ran to 90%, and there was a huge incentive to start pension plans and fund them heavily because the government, in effect, was funding 90% of your pension obligation. So there was a great boom period in the inauguration of pension funds, and of course that meant steel and auto and all of those big industries of that time. Charlie?
Yeah, it isn't so much accounting shenanigans as it is deliberate financial practice. Take General Electric. There's been a deliberate increase in financial leverage, which was made possible by the wonderful and deserved reputation. There's been a deliberate increase in repurchase of stock, which General Electric has done even when they're paying huge multiples of book value. That sort of thing does wonders for returns on equity, as reported, as does the process of writing off everything in sight and various extraordinary charges, removing the burden of past costs from future earnings. You put all those things together, and American returns on equity are higher partly because the management is deliberately set out to paint the company as unusually efficient in its use of capital, meaning that it earns a high return on shareholders' equity. Think of how high we could drive our return on equity at Berkshire. I mean, we could make it almost any number you want if we just used enough leverage.
Yeah, we could run it with no equity.
We could run Berkshire with no equity. Yeah. And then people could say, gosh, these guys have finally learned how to manage the damn thing. It's not been an objective around here to reduce the equity to zero. But at other places, in order to make the reported return on equity good, they deliberately pound down the net worth as much as they can.
Yeah, the questioner may have seen, if you look at the S&P figures of the last 15 years, they report them both before special charges and after special charges, and there's been a very significant difference between those two figures. I mean, the American business likes to frequently write off things and say that doesn't count. And of course that takes the equity down, and it actually frequently benefits future earnings because you remove costs that would otherwise hit the income statement in future years.
The truth of the matter is you have part of this is shrewd and correct management of the company's financial structure and operations. And part of it can drift into gamesmanship.